All right, welcome everybody. Doug McKay on the 16th, Friday after the close of March 2012. This, for the record, will be the 13th week in a row that we've had the overall trend in equity markets as long. I want to start out with the weekly. This is a chart that we put up a couple days ago on the 14th, where we drew in this rising wedge on a weekly chart. We'll also flip over to a daily and then also a yearly chart. But in any event, the trend is still intact, especially on a closing basis. We are at the upper end, if not at the top of the rising wedge. So that certainly is a reason for caution. But we could continue to climb up this wall of worry up to 1450, 1440, or even higher. But in any event, based on that rising wedge, based on the number of weeks in a row, and also based on this chart, the daily chart. Let's put in some Bollinger Bands here. We'll talk about why we took a little bit of money off the table today on the long side. And here's your Bollinger Band here, wrapped around price. And normally, when you're above the Bollinger Band for more than 2 or 3 days, more than 2 days, you're going to pull back in to the band area. So we should see some type of correction soon, although we've been saying that for weeks. So let's get specific here. We would call a trend change not all the way down to 1340, which was the low of last week, which we wanted to see hold. But we would now put it under the low of this past week. So let's just go with the low that was put in on Tuesday on the S&P, and let's just give it a round number of 1370. If we get through 1370, that means we broke this trend line, and we also broke most recent support, which last week was resistance. All right, so let's talk about 1370, or let's mention 1370 as our number. All right, so we have that. As far as the trend line, we want to see that hold. We'll end support, near-term support, 1370. And we are above the Bollinger Band. I'm just cleaning this up because I want to flip over to a clean-looking yearly chart. And let's draw in some scenarios there. Okay, so if we go to a yearly, we do this almost every week. Very good-looking chart on the S&P. And let's get rid of the ABC here. And you guys can find the ABC or 1, 2, 3, 4, 5 on a still chart we put up on the blog just a couple days ago. But here we are looking at a yearly chart. So as we all know, in 2000, 2007, the market was cut in half at a minimum. Could it happen again? Certainly. So a couple scenarios here. If we continue to move up over the next 7, 8, 9 months, and we get through these highs or to these highs of 1500, we could triple top there, or we could run into resistance here. I'm looking at this longer term of 1500 roughly, this area of resistance. And instead of coming all the way back down, what we could do is chop sideways here and then move to all-time highs through 1500, through these highs back here, and through these highs, meaning through, let's say, 1540, 1550. So that could happen. But in the meantime, certainly a correction is in the cards and healthy for the market. So again, to recap, we want to be able to hold this low of Tuesday. We'll call it 1370. We don't want to sit all the way back here at 1340. We think if we break 1370, we're going to test 1340. Very similar to last week when we were here. We thought that if 1340 didn't hold, we were going down to 1320 or 1300. So all we've done is basically raised our line in the sand to 1370. All right, so that's equities. The overall trend is long. To take some money off the market or off the table here on the long side would probably not be a bad idea. I think if the market started to head down and you didn't do it and it stayed down for a while, you might be disappointed. Let's take a look at gold. I don't think I would be fading gold here or treasuries. I think they're going to bounce here. This was a chart that, or a still chart that we dated on the 5th when we said last week that we thought, or the week before, we mentioned this again last week, we thought we'd get to 168, 166 on gold. We got, just above 166. We fell again. We broke this area of support. I think we're going to run up here a little bit. But if you were going to take this trade on a bounce, even though the overall trend is down, I would want to see the lows of Wednesday hold. And you might even want to wait until we got above this on a close. But if you do take a shot at this, I'd wait for the Wednesday lows to hold. If you're looking to get short, maybe I'd shoot for that 166 area again if we get up and around there, and I would have your stop maybe at around 172, 171. But this has been, I would just wait till this cleans up a little bit. If you are short this, I would stay short unless we got above 170. Let's take a look at treasuries, and we all know that these got hit this week. Remember, we were talking about getting through 106 before we would get long the IEF. It was in this range. The longer it's in a range, the bigger the move out of the range, either to the upside or to the downside. Obviously, in this case, it was to the downside with volume. When we open this up to a weekly chart on the IEF, you can see that we've got decent support here. And again, very similar to gold, or anything for that matter at this time. If you're going to play a bounce, I would put it under the previous low, which in this case was today's low Friday on the IEF. You can get knocked out a couple times, deal with whipsaw, as long as you can control those losses, keep them small. When it does start to trend, then you can wipe out any host of small losses. Maybe we get a run up here to 104.40 at the most. But again, I would kind of stay away from this. We did miss the short side of this because it happened very quickly. But if we pull in to basically fill this gap around 20, I always say the word basically, but if we pull in to fill this gap around 20, we would probably take a shot at this and maybe put our stop in around 19, which would be a pretty low risk entry, especially since this is double short. All right, but for right now, I don't see any reason to short bonds or short gold. I think you'll be able to get better entry prices, but clearly the overall trend is down. We are only playing equities, as I disclosed, at least as of late on the blog. Here's a chart of the dollar, and we said on the 13th, 3 days ago, that the buck and treasuries and gold have been choppy and gappy. Good volume today. This was actually breaking out. It did break out. It did get above this area of resistance. It did get above the 50-day moving average. But we were concerned about this gap. And it basically looks, again, like it's going to come back down and fill a gap. So for our purposes, at least in the managed accounts, at this time, we don't have a position long or short in gold, long or short in oil, long or short in treasuries, long or short in any currencies. We're just playing the dollar. We're just playing equities. And we did take some profit again this morning. Let's take a look at a chart of the actual rate on the 10-year. And obviously this is going to look inverse to the IEF, but you can see we broke above this area of resistance here. And again, it was just a breakout, very similar to the inverse of that, which was a breakdown in long treasuries. Let's take a shot here at corporates. LQD broke down through support. We could draw a line in here. Everything's easy after the fact. But we could draw a trend line in here, either to look like this, or we could even open it up a little bit to look like this. But in any event, it did break the trend line. That's the first signal to sit up in your seat and look to get out if you haven't gotten out. And then also at that time support. And you can see this became self-fulfilling. Again, I would not look to short corporates here, just like I wouldn't look to short treasuries. I think you're going to get a better entry here because everything is, at least on that end, is oversold. Let's see if junk is holding up. High yield holding up. Where would I have my stop? I'd probably have it under today's low. Worst case scenario, I would have it under the low that was put in on 3.6, which is right around that 39.15. Where would I get long this? You know, we could be looking at a head and shoulders bearish pattern, left shoulder, head, right shoulder. Why not wait till it gets above, if you're going to get long this, wait till it gets above the high that was put in this week. That high on Tuesday was 39.86 intraday. I would just wait till it got above that. That's not too far off of 39.57, which was the close today, and I would just have my stop tight under today's low. Maybe you could hide it a couple ticks under that, which would be the 50-day moving average. So again, the overall trend on equities is long. Let's do this. Let's just put a Bollinger Band in. We'll add one more indicator here, or we'll go back to where we started with the Bollinger Band on price. And let's do that on the XPX. And there we go. The overall trend is intact. And we can finish it up, draw a trend line in on a daily. So we want to see, we want to see the lows of this week hold. Or let's even tighten it up a little bit more than that. We'll sit up on our seat if we take out the lows that were put in on Tuesday of 1371.92. So let's say 1370. We think if we break this area of support, 1360, that would definitely be a reason to get short. But the overall trend is long for the 13th week in a row. We'll see you guys next week on the blog. Happy St. Patrick's Day tomorrow. Doug McKay, antiwallstreetguy.com on the 16th of March, 2012. Thanks.